Stop contributing to your retirement account. Yes, you heard that right. There's a mathematical point, a precise moment, where every dollar you add becomes irrelevant, where compounding takes over completely, where your contributions literally don't matter anymore. And here's what nobody tells you. Most people reach this point and don't even know it. They keep grinding, keep sacrificing, keep dumping money into accounts that would reach the exact same finish line without them. But there's a catch. A hidden risk that could destroy everything the moment you stop contributing. A risk that has nothing to do with how much you save and everything to do with when the market decides to crash. Today, I'm going to show you the exact number, the precise moment, and the one critical strategy that separates confident retirement from financial catastrophe. Let's get into it. You've been sold a lie. The financial industry wants you to believe you need to contribute forever. Maximum contributions every single year until you're 65. That's how they keep you scared. That's how they keep you working. But here's the gut punch reality. You're probably over-contributing right now. Think about it. You're 35, 40, maybe 45 years old. You've been investing for a decade, maybe two. You check your balance. It's grown. But you're still anxious, still wondering if it's enough, still maxing out that 401k every year because some calculator told you to. Meanwhile, your quality of life today, suffering. Can't take that vacation. Can't upgrade your living situation. Can't invest in your business idea. All because you're told to keep feeding the retirement beast. What if I told you there's a specific dollar amount, let's call it your freedom number, where mathematics takes over and your contributions become background noise? What if you've already crossed that line? But what if stopping at exactly the wrong moment could cut your retirement nest egg in half? That's the paradox we're solving today. The moment of freedom that requires one final layer of protection. Stay with me, because what I'm about to show you will change everything you think you know about retirement planning. Let me show you the math that changes everything. You need to understand the rule of 72. Take 72, divide it by your average annual return, and that tells you how many years it takes for your money to double. If you're getting 8% average returns, which is conservative for stock market history, your money doubles every 9 years. 72 divided by 8 equals 9. Here's where it gets insane. Let's say you have $300,000 in your retirement account right now. You're 40 years old. You want to retire at 65. That's 25 years. In 9 years, that $300,000 becomes $600,000. Zero contributions. Just sitting there. In 18 years, $1.2 million. At year 25, when you hit 65, you're looking at approximately $2 million, maybe more. And you didn't add a single dollar after year one. Now, let's say you keep contributing $10,000 per year for those 25 years. You add $250,000 total. At 8% growth on those contributions, you'll add roughly another $730,000. So you end up with about $2.7 million instead of $2 million. Here's the question that should blow your mind. Is $730,000 extra over 25 years worth sacrificing $10,000 of your annual lifestyle right now? That's $833 per month, every month, for 25 years. But before you get too excited, we need to talk about inflation, because that $2 million number, it's a lie. Well, not a lie exactly, but it's not telling you the full story. That $2 million in 25 years won't buy what $2 million buys today. At a 3% inflation rate, which is historically conservative, your purchasing power gets cut almost in half. That $2 million will spend like roughly $1 million does today. This is what I call the real purchasing power reality. And it's the difference between people who understand money and people who just accumulate numbers on a screen. When you're doing these calculations, you need to think in today's dollars, not future inflated dollars. So when you calculate your freedom number, multiply your current annual spending by 25, then run your compound interest calculations, but also run a parallel calculation factoring in 3% annual inflation. The truth is always somewhere in that tension between nominal growth and real purchasing power. Now here's where most financial advisors stop. They show you the pretty numbers, tell you to stay the course, and send you on your way. But there's one catastrophic risk that could destroy this entire plan. A risk that has nothing to do with your contributions and everything to do with timing. A risk called sequence of returns. And if you don't understand it, you could lose a decade of financial freedom. I'll explain exactly what it is and how to protect yourself in just a moment. But first, you need to understand when you actually hit the crossover point. There's a specific threshold, a crossover point, where your annual gains from compound interest exceed your annual contributions. This is the moment everything changes. When your portfolio grows by $50,000 in a year, and you're only contributing $20,000, you've crossed over. When your money makes more money than you do, that's the signal. Most people never identify this moment. They hit it around their late 30s or early 40s and keep behaving like they're 25. The math has changed, but their behavior hasn't. Here's the rule. When your annual compound growth exceeds 150% of your annual contribution, you've hit the moment where contributions become optional, not worthless. Optional. This is freedom. You can now choose to keep contributing, or you can choose to invest in today. But remember that hidden danger I mentioned? This is where it becomes critical. Imagine this. You're 45 years old. You've got $500,000 saved. You calculate that with 8% returns, you'll have $2.3 million by age 65 without adding another dime. You've hit your crossover point. You decide to stop contributing and start living a richer life today. Then, year one happens. The market drops 20%. Your $500,000 becomes $400,000. Year two, another 10% drop. Now you're at $360,000. You haven't panicked. You stayed invested. But here's the brutal truth. Those early losses devastated your compounding timeline. Instead of $2.3 million at 65, you're now on track for maybe $1.4 million. Same average returns over 20 years. But the sequence, the order of those returns, destroyed your outcome. This is sequence of returns risk, and it's the silent killer of early retirement dreams. Think of compound interest like a snowball rolling down a hill. The bigger the snowball at the top, the more snow it picks up on the way down. But if something smashes your snowball early in the journey, it never recovers that lost mass. Same hill, same snow, but a much smaller snowball at the bottom. So how do you protect against this? 3 strategies. First, the 2-year cash buffer. Before you stop contributing, build a cash reserve equal to 2 years of the contributions you were planning to make. In our example, that's $20,000 set aside in high-yield savings. If the market crashes in year 1 or 2, after you stop contributing, you deploy that cash buffer back into your retirement accounts, buying stocks when they're on sale. You're essentially hedging the worst-case scenario right at your crossover point. Second, the equity glide path. As you approach and pass your crossover point, gradually shift 10 to 20% of your portfolio into bonds or more stable assets. Not because you're getting conservative, but because you're creating a cushion against sequence risk. You're still 80% in growth assets, but that 20% buffer means a market crash doesn't hit you as hard, right when compounding matters most. Third, dynamic rebalancing. Set a rule. If your portfolio drops more than 15% in the first 3 years after your crossover point, resume contributions temporarily, even small ones. To accelerate the recovery, you're not locked into never contributing again. You're making informed decisions based on market conditions. These aren't just theoretical strategies. This is the difference between people who retire comfortably and people who have to go back to work at 68 because they didn't protect the early years after their crossover point. Let me introduce you to Jessica and Marcus, both 35 years old. Both have $250,000 in retirement accounts. Jessica listens to traditional advice. She contributes $15,000 every year until 65, 30 years. She puts in $450,000 total of her own money. Marcus does something different. He stops contributing at 40. Just 5 more years of $15,000 contributions. He adds $75,000 total, then never touches it again. But here's what Marcus did that Jessica didn't. Before he stopped contributing, he set up his sequence risk protection. He built a $30,000 cash buffer. He shifted 15% of his portfolio to bonds. And he committed to resuming contributions if the market tanked in the first 3 years after stopping. Fast forward to age 65, Jessica, with her $450,000 in contributions, plus growth at 8%, she ends up with roughly $2.8 million in nominal dollars. But remember purchasing power. That's equivalent to about $1.4 million in today's money after 30 years of 3% inflation. Marcus, who stopped at 40 with only $75,000 in additional contributions, his $325,000 base grows for 25 years. Even accounting for one market correction where he deployed his cash buffer, he ends up with approximately $2.2 million nominal, or about $1.2 million in today's purchasing power. The difference, about $200,000 in real terms. But here's what changes the entire story. What did Marcus do with that extra $375,000 he didn't contribute between age 40 and 65? He started a side business at 41. It failed. Cost him $50,000. He tried again at 44. This one worked. He built a business that generated $80,000 annually in profit by age 50. He traveled. He invested in his health. He paid for his kids' college in cash, no loans. He lived a rich life now while his retirement grew automatically. Jessica? She has $200,000 more at retirement in real purchasing power. But she spent 30 years in the same corporate job she hated because she couldn't afford to take risks. She has no passive income, no business, no experiences. Her entire identity is wrapped up in that retirement number. And here's the kicker. Jessica is terrified to actually retire. She's caught in what I call the one more year syndrome, and it's destroying her chance to actually enjoy the freedom she worked so hard to build. This is the psychological trap that catches almost everyone who hits their freedom number. You run the calculations. You've got enough. The math is clear. You could stop contributing. You could retire early. You could take that sabbatical. But then the voice starts. What if there's another crash? What if I get sick? What if I live to 100? What if it's not enough? So you work one more year, then another, then another. I've seen people with $4 million in retirement accounts still maxing out their 401k at age 62, terrified they don't have enough. Math says they're fine. The emotions say they're broke. Here's what's really happening. You've spent 30 or 40 years operating from a scarcity mindset. Save more, contribute more, sacrifice more. That mindset doesn't just turn off because a spreadsheet says you've won. Your brain has been wired for accumulation, not for spending, for deferring, not for enjoying. The one more year syndrome isn't about money. It's about identity. If you've defined yourself as the responsible one who saves, what happens when saving is no longer necessary? Who are you then? This is why people die with millions in the bank, never having spent it. Not because they were smart, because they were scared. Here's the antidote. Set a freedom number, yes, but also set a freedom date. A specific date when you will transition, regardless of market conditions. As long as you've hit your minimum threshold, write it down, tell someone, make it real, and then build a bridge. Don't go from maximum contributions to zero overnight. Taper over 3 years. Reduce contributions by a third each year. This gives your psychology time to catch up with your mathematics. It lets you practice feeling financially secure while spending more. It's training wheels for freedom. Because here's the truth. The hardest part of financial independence isn't getting there. It's giving yourself permission to actually be independent. Now let's talk about the other side of the equation, spending your money in retirement. You've probably heard of the 4% rule. Withdraw 4% of your portfolio each year, and it should last 30 years. It's simple, it's clean, and it's dangerously outdated. The 4% rule was created for a very specific historical period and assumes you'll spend the same amount every year, regardless of market conditions. That's not reality. That's not intelligent. And it certainly isn't bulletproof. Let me show you a better way. Dynamic spending. Here's how it works. You set a baseline withdrawal rate of 4% in normal years, but you create rules for market volatility. If your portfolio is up more than 15% in a year, you allow yourself to increase spending by 10% the following year. Take that extra vacation. Upgrade your lifestyle a bit. Enjoy the win. But if your portfolio drops more than 10% in a year, you reduce spending by 5 to 10% the following year. Skip the luxury purchases. Tighten the belt temporarily. You're giving your portfolio room to recover. This isn't about deprivation. It's about flexibility. It's about responding to market realities instead of pretending they don't exist. Think of your retirement portfolio like a reservoir of water. The 4% rule says you can drink exactly 1 cup per day, every day, no matter what. Dynamic spending says you check the water level regularly. If it's overflowing, drink a bit more. If there's a drought, conserve for a season. The reservoir lasts longer and you never run out. Studies show that dynamic spending strategies can increase the success rate of retirement portfolios by 15 to 20% compared to static withdrawal rules. You're not just following a formula. You're actively managing your financial life. And here's the part most people miss. Where you withdraw from matters just as much as how much you withdraw. This is called asset location strategy. And it's the difference between keeping 70% of your money versus 85%. You have 3 types of accounts: tax-deferred like traditional 401ks, tax-free like Roth IRAs, and taxable brokerage accounts. Most people treat them all the same. Big mistake. Here's the optimal strategy. In your working years, put high-growth stocks in your Roth IRA. Why? Because that growth will never be taxed. Ever. The money you put in has already been taxed. So when you pull it out in retirement, including all the gains, it's completely tax-free. That's where you want your biggest winners. In your traditional 401k, hold dividend-paying stocks and bonds. These generate income that would normally be taxed every year, but inside a tax-deferred account, they grow untaxed until withdrawal. You're deferring the tax bill to retirement when you're likely in a lower bracket. In your taxable brokerage accounts, hold tax-efficient index funds and stocks you plan to hold long-term. Long-term capital gains are taxed at a lower rate than ordinary income, so you minimize the tax bite. Now here's where it gets strategic in retirement. You withdraw from these accounts in a specific order based on your tax situation each year. Generally, you want to tap taxable accounts first, living off long-term capital gains at lower rates. Then you strategically pull from tax-deferred accounts to stay below key tax bracket thresholds. And you save your Roth for later in retirement or for legacy planning, since it's the most valuable from a tax perspective. This isn't about being a tax expert. It's about understanding that two people with the same $2 million in retirement savings can have vastly different lifestyles based on where that money is located. One person might net $60,000 per year after taxes. Another might net $80,000. Same portfolio size, different asset location. If you're approaching your crossover point, this is the time to get strategic. It might mean doing Roth conversions in low-income years. It might mean being very intentional about which accounts you contribute to. A 1-hour conversation with a tax-efficient financial planner could be worth $200,000 over the course of your retirement. Let's zoom out for a moment. We've covered a lot. The rule of 72, the crossover point, sequence of returns risk, real purchasing power, the one more year syndrome, dynamic spending, asset location. But here's what all of this really comes down to: the transition from mathematical certainty to emotional freedom. The math is actually the easy part. Compound interest is predictable. Tax strategies are learnable. Inflation is calculable. You can figure out your freedom number. You can identify your crossover point. You can build the perfect plan on a spreadsheet. But living it, trusting it, actually shifting from accumulation mode to enjoyment mode, that's where most people fail, because retirement isn't an age. It's not even a number. It's a state of mind where you trust that you have enough, where you believe that the math you've built will hold, where you give yourself permission to stop deferring your life. I've met people with $5 million who are miserable and scared. And I've met people with $800,000 who are living rich, full lives because they understood their crossover point and designed their life around it. Wealth isn't about the size of your account. It's about the quality of your decisions and the confidence in your plan. You stop living like you're broke when you're not. You stop deferring your life until 65. You realize that the best investment might be that business idea, that certification, that networking trip, that health coach. Because wealthy people don't just have big retirement accounts. They have multiple income streams. They have valuable skills. They have relationships and experiences and capabilities. Your retirement account is one tool, not the only tool. And there's a mathematical moment, probably sooner than you think, where that tool no longer needs your constant attention. Find that moment. Protect it with sequence risk strategies. Understand the real purchasing power. Break the one more year syndrome. Plan for dynamic spending. Optimize your asset location, then live accordingly. Not recklessly, not foolishly, but intentionally, confidently, fully. Here's what I want you to do right now. Pull up your retirement account balance. Write it down. Calculate what it will be in 25 years at 8% annual growth with 0 additional contributions. Use a compound interest calculator. I'll link one in the description. Then run it again with a 3% inflation adjustment to see the real purchasing power number. Compare that number to your retirement goal. Remember, 25 times your annual spending in today's dollars. If you're already there, congratulations. You've reached the moment. But before you stop contributing, build your sequence risk protection. 2-year cash buffer, equity glide path, dynamic rebalancing plan. If you're not there yet, calculate exactly how much more you need to contribute to hit your crossover point. Then create a plan to get there in the next 3 to 5 years, not the next 30. And set your freedom date, not just your freedom number, but the actual date when you'll transition. Write it down. Make it real. This isn't about stopping investing. It's about investing consciously. It's about recognizing when the math has shifted in your favor. And it's about refusing to sacrifice your entire present for a future that's already secured. The exact moment you no longer need to invest for retirement might have already happened, or it might be closer than you think. Either way, now you know how to find it. And more importantly, you know how to protect it. Stop letting fear drive your financial decisions. Let mathematics drive them instead. But let wisdom guide how you actually live. If this changed how you think about retirement, drop a comment below with your crossover number and your biggest fear about actually stopping contributions. And if you want me to break down other financial rules that might be holding you back, let me know what to cover next. Until then, invest smart, spend dynamically, live intentionally. And remember, your money should serve your life, not the other way around.